Hey everybody, this is Todd Zempel, and I have with me Joe Gordon here today to share with you the September 22nd market update. First thing, we're a little bit excited today because we are actually launching a new podcast. So we'll record today's webinar in the form of a podcast, but look for more information from us on that. We'll publish our podcast, Spotify, iTunes, etc., etc. So that said, let's go ahead and jump right into the presentation today. Of course, follow us on social media, Twitter, Facebook, LinkedIn, etc. Again, look for us on Spotify and iTunes shortly. There'll be a formal update on that coming. Jump right in. Joe, do you want to take the coronavirus update?
Oh yeah, always. Hello everyone. This is the basic slide we use every week just to get a broad brush view of what is going on. You can see the total cases approaching 7 million or 6.5 million, a little bit, 300 to 400,000 over the prior week. And that's up there in the purple. And then you see that hospitalizations decreased by a little bit week over week. So that's positive. And then COVID deaths has climbed just under 200,000. Interestingly, former Vice President Biden had a gaffe saying 200 million, but on testimony in the House, I just witnessed another person in Congress saying 200 million people had died. So it's really 200,000. Not making a joke of that, 200,000 is too many, but it is what it is, and it's not nearly a significant fact.
Yeah, Joe, the stat that I like to follow is the hospitalizations, because obviously that's going to front run any deaths. So seeing a constant decline in hospitalizations is very positive. A lot of people say that as this thing started tearing through the country, so to speak, that a lot of the weaker folks, the elderly folks that had pre-existing conditions, those folks tended to pass on early on. And not to sound calloused, of course, this is horrible, but the fact that hospitalizations are decreasing is definitely a positive sign.
Yeah, one other thing that's anecdotally, which will be interesting to watch, is since the NFL season is now kicked off with two weekly games, 2 weeks, a number of the stadiums, for example, Dallas this past Sunday, they had over 20,000 people there. Kansas City 2 weeks ago opened the season with 17,000 or so. It'll be interesting to see if there's any clustering or hotspots created from that overall, and we'll update you on that. Going forward, a couple things worth noting. The CDC, Centers for Disease Control, is getting a lot of grief, if you will, in the media because of things they're posting that are not necessarily their information that they produced, and it turns out they're wrong. So you can see the first bullet here. They posted draft guidance on airborne transmission, and then it turned out the World Health Organization said there's no evidence. You can get it from airborne particles, and it travels beyond 6 feet. I don't know why they published that. I saw a testimony today, or an interview today on CNBC this morning, where that very issue was being debated, that the CDC shouldn't really publish anything on their website other than information that they produce themselves. So, and then also they had another error came to light, that you really didn't need a test if you were exposed to an infected person and you weren't showing any symptoms. Obviously, so many people that turned out were positive were asymptomatic. So that I don't know why they published that as well, but it is important to note. So keep an eye on that.
Yeah, and this is very interesting for me to watch. You know, it's the conspiracy theory. You know, I think it's strange that the CDC did come out and say, well, you don't necessarily need to be tested if you've been in contact with somebody who's had COVID, even though you hadn't had any symptoms. I'm like, that's a little bit of a head scratcher. The fact that they reverse course on that, I think, is positive, but you know, enter all the conspiracy theories about Trump circumventing the CDC on some of this stuff. So it's interesting. It's a little bit sad to see that it's politicized, but we'll see where things go from there.
Okay, so now looking at case changes, the light blue, you got world cases month over month up 36% in the world, and the olive green, you can see death percentage change in the last month up 20%, a little over. And then in the purple is the US coronavirus case percentage change in the last month, up 21, 22%. And then lastly, deaths percentage change up just under 15% over the last month.
Yeah, and that's the the big concern in the international markets right now is COVID and potential COVID lockdowns happening in Europe. So we'll see how things develop there, but it's definitely something that we're keeping an eye on.
So now, how does that affect the markets? Well, one of the things we've been cautioning about all year since the first blowout in mid-March was that the markets globally were kind of on weak foundation. So you can see here what happened last week. Developed markets outside the US, the Europe, Australia, Far East index were down 2.64%, which brings their year-to-date total just minus 8.84, just under 9%. Emerging markets, which had been rallying a little bit on a weaker dollar, also fell 1.25%. They're down now 2.18% year-to-date. And then also the flight to safety, if you will, the global aggregate bond index, if people were not invested in stocks, still positive at plus 6% year to date, but with zero bound interest rates. There's probably little upside there. And then in the US market, we're starting to see cracks in the foundation. You know, we've been on what we call a sugar high. A lot of people refer to that as all the Fed stimulus. And for anyone on the call, you also know that there is no second stimulus bill. It is totally being sidetracked by politics, the House versus the White House and the Treasury Department, or call it Pelosi and Schumer in the Senate versus Mnuchin. And so it's going nowhere likely at all before the election. And the vast differences are $500 billion to $1 trillion between COVID-related things only, and then also a lot of goodies that the House wanted to throw in there that had nothing to do with the COVID response. So if you look at U.S. markets, they sold off just under 3% last week, bringing the year-to-date down from over 5% the prior week to 1.93% year-to-date. So basically flatlining. And then you can look at NASDAQ, which supposedly was impervious to anything about gravity in the markets, fell 2.57%, now up only 26.57 year to date. That's still a great return, and anybody that's all in NASDAQ, while not happy, they were up 33, 34, they're only up 26 now, but still, that's the mega techs going parabolic primarily, which we'll see in a sec. And again, we've said it from April, that if this were a sustained rally in a new bull market, you would have to always normally see small stocks lead it. Russell 2000 fell 3.1% last week. It's now down almost 11% year to date. And basically that supports our argument that we are in a bear market rally, not a new secular bull market. And if you look at fixed income, fell a little bit last week, not much, but year to date, the Barclays US aggregate index is up 6.96%.
Yeah, and what I like about this chart, Joe, is that it shows why it's important to have a diversified portfolio, right? You look at this line here, the Barclays Ag, so bonds. If you held bonds in your portfolio through the March COVID sell-off, you would have done a lot better, potentially over that time period. So again, it's just a good reminder, and this is a good snapshot to see this play out in action. But having a diversified portfolio, including bonds and stocks, it tends to be the best course of action for most people.
So when you look at sort of a trend reversal, this slide basically is addressing the outperformance of equal weighted indexes over market cap weighted indexes. And if you look at it since the 1st of September, you can see equal weight is outperforming. So the S&P 500 is the equal weight index in green. You can see down 4.21% in the month of September. But if you look at the regular market cap weighted index down 6.61. And again, about a quarter of that index on a market cap basis is your 5 mega tech stocks. And then if you look at NASDAQ by itself, the purple, the equal weighted index is the orange, I'm sorry, is down 7.25%. And then the purple, being the market cap weighted, is down over 10%. Some say, hey, is this a rotation from growth to value? I'm not so sure it's a rotation from growth to anything, but because for value to come back, you normally have to have financials. Financials are not making money in this environment. In fact, they have over-reserved bad loan loss estimates in Q2, and we think you'll see record earnings coming out and after Q3 in October because they realized that the carnage they were expecting wasn't as severe. But industrials and materials are typically value sectors. They have done better on a relative basis in the last couple of weeks, but they've been flatlining the last few days as well. So here's the kind of the tell-all slide is when you look at the broader market, the S&P 500 level down 6%, 6.56% this month, and then you look in September. The mega techs, you can see Apple down 17. It was down 25% intraday yesterday, and actually rallied significantly from like $102 a share to 111. It's flatlining today around 109, 110. But also Microsoft's down 10% from its high, Amazon down 12.84, Facebook 15.41, and Google 12.58. So basically shows that the mega techs, cannot defy gravity forever. Sooner or later, people are going to sell into strength, and the ones that were selling into strength at the end of August, obviously, are feeling really good about that decision. So still, though, when you look at it year to date, you can look at rates of return. The S&P is only up 1.99%. So if you're diversified in stocks, you're probably not all that happy. But if you own a slice of these mega techs, you can say, well, Amazon's still up almost 65%. Apple's up 51.5%. You've got Microsoft up 29%. And then you've also got Facebook up to almost 22%. And the only real laggard is Google up, but who wouldn't take it, up 8.58%. So again, the mega techs have ruled this year, and a lot of other tech companies have done well too. The stay-at-home stuff like DocuSign for electronic signatures on every document, and then also Zoom and things like that. So it hasn't been just these five, but these five are a good snapshot. If you look at sectors, this is an extremely busy slide because we've got all of the S&P 500 index sectors. There are 11 of them. And you can clearly see from a standpoint of July of 18 going forward, you see everything went down in March of this year and the two-thirds of the way over in the slide. And then you see the rebound. And the rebound has been especially kind to technology, that sector up 55.63%. And then you look at right below it in the dark green, and you've got consumer discretionary. And then if you look at traditional sectors that normally would do well, if you were having a rebound, I mean, the poster child for anemic returns is energy down at the bottom at -58. And obviously there was a demand problem in April. No one was using energy to fly, drive, or anything. And so not a supply. The supply issue was where you store it, but energy is still way down year to date. And then a number of the other sectors are also lagging. The ones we normally would like in a zero interest rate environment, utilities and real estate, haven't really done all that great either. I'm looking at the pink is real estate up 8%. And then I'm looking for utilities, the green, lime green, up 16% over this 3-year period. So still done okay, but year to date, they haven't done that well from their peaks. So valuation, we look at this every week. Again, stocks are not as richly valued as they were at the beginning of September, but they are still, and again, this is the S&P index, of which 23 to 4% of it is the 5 megatechs. But you can see that when you look at this graph, dating back to the bubble-licious days at the turn of the century, 2000, 2002 is the last time we had valuations approaching 2 standard deviation events. So we're still above normal, and you can see the PEs just 21.4 times earnings, where the 25-year average is 16.5 roughly. But again, if we took the 495 stocks that are not the 5 mega techs and we looked at their valuations, it's really in the 16 to 17 times. So I'm not that worried about that, except when you look in textbooks and graphs, this is not a chart you want to see with stocks overvalued. Future returns when they're this high usually are not that great, which you can see to the left when things peaked in 2000, 2002. The returns and PEs came way down.
Yeah, and it is nice to see a little bit of mean reversion on this PE ratio. What it says to me when I look at this chart is, hey, this little bit of a correction that we've had over the past couple of weeks is indeed healthy. We have corrections in the course of just normal market activity, and the fact that we're backing off some of these highs in price to earnings ratios is definitely signaling a healthy return back to normal.
So let's go to a transition here to unemployment, and you can see here in the left a couple bullets. Continuing claims fell 750,000 last week. Currently 12.63 million. Initial claims fell 24,000 to 860, and the unemployment rate's currently at 8.4 from a peak of 14.7. And again, in testimony before the House Financial Services Committee, as we speak, Mnuchin highlighted this particular type data point as a reason why they did what they did at the Fed and the Treasury, and why they put so much stimulus in order to not have the disaster scenarios of up to 25% unemployment that some were talking about in late March, early April. So clearly the injection has worked, but everyone seems to feel we need more PPP and another round to get through the virus. So Fed testimony, again, Powell's there with Mnuchin right now, but basically said we're going to continue aid as long as it takes last week. He also said they were not going to fight inflation any longer, I guess because they fought it and they lost. And basically, hey, there's uncertainty, so we're going to be status quo. We're going to be zero bound on interest rates to, I think he said, at least 2023. Which gives you some certainty of what to expect. So if you have a mortgage you haven't refied, you probably want to do that. And then one of the things that's controversial, this Main Street lending program, the bottom bullet on the left, is that a lot of people think it's the government not willing to lend that money, but it's not. It's just basically the minimum loan right now is $1 million. They're considering lowering that. And the financial and other application processes is significant. So it's really more for mid-market companies. It's not for your typical mom and pop business, but they may take some of that budget and make it more readily available to what I would call Main Street small business prospectively, and that's under discussion.
Yeah, and actually, just before we stepped in here, I was listening to a little bit of what Powell was saying, and what it seemed to me when he was speaking, it seemed to me that he was signaling to the government, the Senate, that, hey, you guys, if you want to stimulate, go ahead, green light, we'll monetize any additional debt. One of the things that he mentioned that I thought was interesting is he was speaking with Maxine Waters and kind of made it clear that this Main Street lending program wasn't really intended for small companies, and that we potentially need another PPP. So when you look at folks like Jay Powell speak, to me, it's all about signaling to the folks on Capitol Hill that, hey, if you want to go ahead and go this route, offer more PPP money, stimulate, we're giving you the green light, we're on board. So obviously everything's political right now, and who knows what will get done, if anything, before the election, but that it is something that we're closely watching. Now, the next slide, I thought this was interesting. I charted out the S&P 500 index, NASDAQ, Barclays Bond Index, and the Russell 2000 small caps over the presidencies of both Barack Obama and so far with Donald Trump. And it's kind of interesting. You look at these two charts side by side, even though one's 8 years and the other's 4 years, they look very similar. A lot of the questions we get from clients, friends of the farm is, hey, what's going on with the election? Should I put all my money in cash? Should I hide it in the mattress? What should I do? I'm pretty worried. The net result, and Joe's talked about this on prior webcasts that we've done, is the net result is not much happens with presidential elections. I think if anything, the president has to bend to the whims of the powerhouse U.S. economy versus driving actual results in the market. Joe, what are your thoughts on that?
Well, there's a lot of political stuff going on, and there is widespread sentiment that what Z just said is totally true, and it's being written about all over the world. And in a missive I read yesterday from Louis Gav at GavCal, he lives in Hong Kong, or at least he used to. I don't know where he lives now, maybe Singapore, since it's probably safer. But they write globally, and they talked about the same issue. It doesn't matter who becomes president. I saw someone on CNBC this morning saying the same thing, that, yeah, there'll be changes here and there, but by and large, you're going to have similar results. And that's why these two charts do look strikingly similar across all four of those indexes. And so we'll see. But for people think that the world is ending and so forth, I don't really buy into that thesis. But clearly, we have clients that want to be conservative and have gone to treasuries and some gold. And one thing is for sure, if they do another round of stimulus, which it's pretty much in the cards that they will, I think you'll see precious metals, mostly gold miners, silver miners will respond positively to that. So clients that have that as a hedge, it's probably a good thing, because it's pretty much a given thing. The stimulus will happen. It's just how much. So things that we're watching as we transition here at the end of the day, obviously in North Carolina, for our North Carolina clients, which are most, you have the school going initiative politically. You have the governor saying that the K through 4 or 5 elementary kids can start October 1. Then you had the teachers union respond back that they won't do it. They'll go on strike. I don't know what's going to happen there, but clearly you have that particular issue. And, another thing we were watching about this is the political conspiracy in the city of Nashville, Tennessee, which is a great place, and how the mayor there shut down all the bars and restaurants after reversal opening, claiming they were the hot spots, when it turned out it was construction sites and hospitals and assisted living facilities primarily. So there's a lot of politicization of this COVID stuff going on everywhere. And we'll just see. I think a lot of people are getting tired of it. You have the mail-in voting thing that's happening, and there have been cases of fraud. In fact, North Carolina actually leads the league, believe it or not, as the state with the highest number of dead people on their voting rolls. A lot of states just are required to clean their voting rolls, but they don't ever do it. So you end up with a lot of dead people who are still registered to vote, and somehow some of them do vote. I wonder how that happens. But anyway, but also you've got the money supply expansion, the stimulus issues we've already talked about. The mega techs are peeling back a little bit. There is a lot of talk that there's going to be massive regulation of some of the mega techs, especially Facebook and Google. And then you've got dollar weakness against the euro. The euro's kind of hanging in there. It's about $1.18 per euro as we speak, as of yesterday. We'll see what happens there. And again, growth versus value, we're looking at it, but I don't think you're really going to see that rotation happening unless the economy amps up a little bit going forward.
Yeah, so with that, like I mentioned at the top of the webcast today, we're going to actually transform this webcast into a simulcast, as well as a podcast that we'll make available on iTunes and Spotify. We'll be doing lots of new and interesting things, inviting guests on, business owners, potentially folks at some of the investment companies, mutual fund companies, money managers that we work with. So as we go forward, please give us your feedback on what you think works and what doesn't work, and we'll definitely take that into consideration. So with that, folks, hope you have a great day. Thanks for attending.